Hello students, so welcome to this 8th class of your CA final May 24, November 24 regular batch and CMA June 24, November 24, the final regular batch. Now students, this would be a very small session in which I have to just close the yesterday's discussion that we doing, and once that has been closed, then tomorrow we will be starting with the most important section of the non-resident taxation, students, and that is your section number 9, the income which is deemed to accrue or arise in India. Very important discussion, students. This is going to be a breakthrough for all of you in your CA final journey. So students, on that note, let's start on this. I think you have solved this question. I gave you this question for homework, isn't it? Question number 2. Let's discuss quickly, and then one last concept which I have to discuss. We'll complete that also. So, ABC Limited, software giant in India, set up a 100% subsidiary company by name of SHG in Switzerland on 1st of April 2023. So this point, students, we have discussed, isn't it? Remember that? And what was the discussion? That just because the foreign company is a subsidiary company, it may be even a 100% subsidiary, doesn't matter. So just because that the foreign company is a subsidiary of an Indian company, whether that foreign company will it be considered as a resident in India? Whether that foreign company will it be considered to be a resident in India? To that the answer is just because it is a subsidiary. Keep that particular point in mind, students. So this is one. So this is how the things should be considered over here. So therefore, the shareholding control is not important. What is important is the control over the business. All these are important aspects. The subsidiary company SHD Inc. is mainly engaged in software services, hardware services, and data backup services in 3 different countries, which is Switzerland, Sweden, and India. The following information is furnished by SHD for the financial year 23-24. Value of asset as per the books of accounts. Number of employees has been given to you. So obviously, friends, you know what to do, and the total aggregate of income. First of all, outside India test, we can easily make it out. Outside India test, isn't it? So far as outside India test is concerned, asset in India is 24 as compared to the total. How much is the total? So is it less than 50%? The presence of the asset in India, is it less than 50%? The answer is yes. Similarly, if you go to the next one, the total happens to be 68. Is the presence in India less than 50%? Again, the answer is yes. Payroll to the Indian employee, 5.4. Total is 12. So again, it is less than 50%. The answer is yes. So outside India, we are convinced. Let's see whether the business is active in India or not. That is the point. Whether the business is active in India or not. So if you see over here, the total aggregate income has been given to us of 80 crores. Now what we require is the bifurcation, students. In this case, what we require is nothing but the bifurcation. Now if you see the bifurcation, students, over here, breakup of the total income, 28 crores is derived from the transactions where purchases are made from associated enterprise and sold to non-associated enterprise. So will this be considered as a passive income? Will it be considered as a part of a passive income? So I told you that only in the passive income, both the purchase as well as the sale, should be in respect of both the purchase as well as the sale should be in that case. Should be what? Yes. So only then in this case it will be considered in this regard. So keep this particular point in mind, students, all of you. So therefore, this is how the things are to be looked upon. So therefore, this will not be considered as a passive income. Coming to the next one, 24 crores derived from transaction where both the purchase and sale were made from associate enterprise. Is this a passive income? Yes. So this is passive. 16 crores derived from transaction where purchase are made from non-associated enterprise and sold to associate enterprise. This is not a passive income. 8 crores by way of what? Income from capital gains on trading of shares. Will this be a case of a passive income, students? And the answer is yes. This also will be a case of a passive income. 4 crores by way of interest from non-associated enterprise. Will this be a case of a passive income, students? Will this be a case of a passive income? And the answer is yes. So if you see in totality, how much is the amount? 24 crores, 8 crores and 4 crores. So therefore, 24 plus 8 and plus 4. So what is the total? 36. So the passive income is how much? 36. Isn't it? So passive income is 36, students, against the aggregate of 80. The passive income is 36 against the aggregate of 80, and therefore we will conclude what? The passive income is less than 50% of what? Passive income is less than 50% of the total income. Passive income is less than 50%. Shiva. Passive income is less than 50% of the total income. And therefore in this case, we will say, because the passive income is less than 50% of the total income, therefore active business outside India is satisfied. And if ABOI test is satisfied, then what is the conclusion? Conclusion is that the poem is presumed to be outside India, provided the majority of the board meetings are taking place in India. Majority of the board meetings are taking place where? Outside India. So see over here, total 5 board meetings are held. 2 in India, 1 in Sweden and 2 in Switzerland. So total outside India is 3. Majority is outside India, and hence poem is also outside India. Poem is also outside India. I hope that all of you clear. So I think that is what it is. Now students, the last particular area why we are over here, couple of points in this context. First one is a transition provision. So all we came here is for what? The transition provision, students. Be careful on that. Students, just imagine this. The residential status we have to check every year. All of you agree? Residential status. It's not like once a non-resident, always a non-resident. Once a non-resident, always a non-resident, isn't it? We will face one very severe and important problem. Page number 15. 1.5. And students, that issue would really be very glaring. What is that issue, students? Keep that a point in mind, students, in this context. The point, students, over here is this, that supposingly that this thing, that company of Tata Motors, that Jaguar motor car, example I give it to you, for so many years it was not a resident in India, but suddenly now, because of this poem concept, Place of effective management is in India. Because of this concept, students, it is considered to be resident in India. It is considered to be a resident in India. And if it is considered to be a resident in India, students, just imagine this. Then the world income is taxable. Do you all agree? The world income, students, will now become taxable. All of you agree to this one? And if the world income is taxable, then in that particular case, students, what happens? If the world income is taxable, then say for example, business income also will be taxable. The motor car business is outside India, but because you are a resident in India, it will be taxable. Now just imagine this. If PGBP also will be calculated, then I'm just giving an example. In the PGBP, depreciation allowance has to be claimed. Depreciation also would be claimed by him, na? Because you will be computing the world income now under this act. And one of the computation element is what? Depreciation allowance. Now depreciation allowance, students, is on what? Is on the opening WDV. Opening WDV. Question therefore to all of you is, do you have the opening WDV as per the data of Indian tax record? Answer is no. Why? Because up till last year he was preparing the books as per what? The tax record of the foreign country. So the closing WDV that they have is what? Is a tax record of the foreign company, foreign country. And now you say you want open WDV on which you will apply the rate of depreciation as per the income tax rules. But the open WDV you have got the value as per what? As per the foreign data. So the question therefore to all of you is, what is the option now that is there? There are two options. Option is, let's take the foreign data only, open WDV as per whatever is the WDV that they have determined as per their foreign laws. Just consider that and on that apply the depreciation. This is a very simple thing, isn't it? Or there is a second option also now. And what is the second option? The second option is to tell them, tell what? To recompute right from the actual cost till open WDV. What? The depreciation. Recompute everything. And that too as per the rate of depreciation as per the income tax. Can you see that? Now this second option will lead to a very huge exercise. Right from the actual cost till opening WDV. Just you can imagine what kind of labor that will be involved. Articles would have to be hired to do this. Normal person cannot do it. What normal person cannot do it, articles only can do it, isn't it? That is the point. So therefore, students, in this particular case, the government accordingly came up with the notification that look, in the transition year, when the foreign company suddenly has become a resident because its poem is in India, in that year there will be these issues that will be there, and therefore we need to address these issues. And accordingly they have given us some notification. They have given us some guideline, and on the basis of the guidelines, we are supposed to sort out the things. So what is the guideline, students? Let's have a look one by one. See here in situation number 1. All of you, in this context, situation number 1. What they have to say? So what is the answer, students? They have told you the WDV is to be calculated as per the provision of what? The laws of that foreign jurisdiction. One should say thank you to the government, isn't it? A huge laborious exercise. A huge laborious exercise is saved in the process. Otherwise, you could just imagine what would have been the exercise, isn't it? You would have imagined, students, what would have been the exercise in this context. So the WDV is to be calculated as per what? The provision of the laws of that foreign jurisdiction. Fine. Now coming to the brought forward loss and unobserved depreciation shall be determined year-wise on the basis of foreign tax record. So because in India up to 8 years only it is allowed, no? So it may be the case there could be some brought forward loss of say 10 years, 14 years, 15 years. Then what is the position? Only up to 8 years of the last brought forward loss that we have to consider, and the loss would be as per what? As per the foreign tax. But supposingly that country which we are talking about it is not subject to income tax. Even that is a possibility. That country, students, is not subject to any income tax. And if that country is not subject to, students, any income tax, then what? Then the next one will happen, students. And what is the next one? Over here, tax records data is not available, but then at least they would be maintaining the books as per some law like Companies Act in that country. So whatever is the data available, whatever is the data which is available as per what? As per the applicable law relating to the company, on the basis of that data, the value has to be determined. Which value? You can see. Which value? The value you can see for yourself. The WDV. Brought forward losses year-wise and the unobserved depreciation as per the books then. If you don't have a tax law in that foreign country, then as per the books that they would have maintained, you pick up the data and that is what will be considered for subsequent calculation. Now this is an important one, students. Very careful. This is what it is an important point. Students, in the Indian context, in the foreign context, see, we require, opening WDV we require on which date? 1st April. Say 1st April 2023 I require opening WDV for previous year 23-24. 1st April 2023, students, I require the opening WDV for the previous year 23-24. For the previous year 23-24. Isn't it? Now, students, if you see above, in this context, many countries, are you aware of it? They prepare the financial statement on the basis of calendar year. They prepare what? The financial statement on calendar year basis. Are you aware of it or not? Calendar year basis. So this means that from 1st Jan, their last financial statement would be for which period? 1st Jan 2022 to 31st December 2022. First, their last statement, financial statement, is from 1st of Jan 2022 to 31st of December 2022. And I want the values, opening WDV, brought forward loss, unabsorbed depreciation for what period? 1st April 2023. Can you tell me what is the difference? 3 months is the difference. Okay, so the notification says this. What the notification says? If the difference is not for more than 6 months. If the difference is not for more than 6 months, then the last financial statement you extend it up to 31st of March. Last financial statement. You extend it for 31st of March. So tell me, last financial statement would be for then 15 months. Last financial statement will be for how much period? 15 months. Do you all agree? That exactly is the point. So your last financial statement in this case would be for 15 months. Students. I hope that all of you are clear with this. So 12 plus 3, that is 15 months, would be your last financial statement. Okay. However, let's see. In Japan, they prepare the financial statement from 1st July to 30th of June. In Japan, students, they prepare the financial statement from which to which? From 1st July to 30th of June. Are you aware of that? And if this is how they would have prepared a financial statement, so what is the last period for which the financial statement would have been made? So the last period for which the financial statement would have been made would be 1st July 2021 to 30th of June 2022. Because I require the data on 31st March 2023. But their next financial statement would be on what? 1st July 2022 to 30th June 2023. Whereas I require the data on which date? 1/4/2023. So the last financial statement that is available is this. The last financial statement which is available is this. And if this is what is available, can you tell me what is this thing? Delay? 9 months. You can see for yourself the delay is 9 months. And students, if the delay is 9 months, in that case, if the delay, students, is 9 months, in that situation, what? Is it more than 6 months? Yes. So if the delay or the difference is for more than 6 months period, then the law says that you will prepare the financial statement for that period. You will prepare the financial statement for that period. So in that particular case, students, you will prepare the financial statement for 9 months. I hope that all of you are clear with this one. You prepare the financial statement for 9 months. Okay. So if the difference is not more than 6 months, extend the previous period to that extended duration, which is in my first example 15 months. In my second example, because the period was more than 6 months, the difference was more than 6 months, therefore we will prepare a separate financial statement for that difference period, which is 9 months. That is from 1st of July 2021 1st of July 2022 to 31st March. This is the financial statement that I will prepare in the second case. I hope that all of you are clear with this one. Every one of you. Now students, in this particular case, the next particular point. So preparation of balance sheet, we have discussed that particular part. Foreign tax credit, if you see, right now you will not discuss this, we will discuss it later on. Students, can you tell me what will be the applicable tax rate available? This foreign company is a resident now, and because this foreign company is a resident, you know the world income is taxable in India. The global income is taxable in India. All of you agree? The world income is taxable in India, students. The question therefore is, at what rate? The rate would be 40%. Why? Because please understand, very important point. If possible, here you have to write a note. And what is the note? The scope of income chargeable to tax. Be careful. The scope of income chargeable to tax depends upon residential status of a person. What is the scope? What do you mean by scope? How much could be taxed or how much would be taxed? That how much is the scope? That depends upon residential status. And if you are a resident, how much is the world income? But at what rate it will be taxed, what rate it will be taxed, that depend upon whether the company is a foreign company or a domestic company. A foreign company whose poem is in India, a foreign company whose poem is in India, it becomes a resident in India. A foreign company whose poem is in India, it becomes what? A resident in India. It does not mean that it becomes a domestic company. Are you clear with this one? Because many people will think, okay, sir, it has become a domestic company. No, it doesn't become a domestic company just simply because what? Simply because its poem is in India. It continues to remain what? It continues to remain a foreign company. I hope that all of you are clear with this one, friends. Just write a note over here very quickly. The how much of the income will be taxed? How much of the income will be taxed? That is the how much of the income will be taxed. That is the scope. That is the scope will depend upon will depend upon the residential status of the person. Will depend upon the residential status of the person. Full stop. However, at what rate it will be taxed? At what rate it will be taxed? That depends on that depends on whether the company is a domestic company, whether the company is a domestic company or a foreign company. Okay, now students, this is an important one. Rest foreign tax credit and transfer pricing, these 2 points you will come to know later on. Let's focus only on this part of the conflict between the provisions. Now students, many of you may be aware of the fact, just an example. Remember in PGBP, in PGP students, for TDS disallowance, in PGP for TDS disallowance, there are two sections like 40AI and 40IA. So far as 40IA is concerned, 100% disallowance will happen. In the case of 40IA, 100% of disallowance will happen in this case. For 40A, I am talking about it. 100% will be the disallowance, and so far as 40AIA is concerned, the disallowance would be at the rate of 30%. The disallowance would be at the rate of 30%, students, isn't it? So that is the two disallowances, students, which has been there. One at 100, another at 30. But for 100, the payee has to be, who has to be with the payee? Non-resident or a foreign company. Non-resident or a foreign company. And for the 30%, who is the payee? Payee means the receiver. Payee means the receiver. For that 30% disallowance of 40IA, the payee happens to be a resident. Isn't it? So, the question is, if a foreign company whose poem is in India and therefore resident in India, comma, receives a payment without TDS deduction, then the disallowance will be 100% or 30%. Will be 100% or 30%. What is your take, students, on this? Will the disallowance, will it be 100 or 30%? Quickly! It will be, for this, though it's, now this is a conflict, because 40A I refer to both non-resident as well as foreign company, and the 40AIA is referring only to whom? To a resident. And the 40AIA is referring to whom? To only a resident. So therefore, the CBDT in this notification has said what? If it has been clarified that in the case of any conflict between the provision of income tax applicable to taxpayer as a foreign, this is it. So see over here, it has been clarified that in the case of any conflict between provision of Income Tax Act applicable to a taxpayer as a foreign company, and the provision of the Income Tax Act applicable to its capacity resident, the former shall prevail. Former shall prevail means what? The provision of foreign company will prevail. So herein CBDT answer is what? CBDT answer would be the disallowance would be at exactly. Disallowance would be at 100%. Fine. The remaining part, students, which is about the transfer pricing part and all, you will come to know later on. Just keep this particular point in mind, and that should be all. Fine, students. So now, students, tomorrow, which we are meeting it now, all this residential status is through. We are also through with, again I repeat this point, alternate tax regime. Don't forget this. Why you should not forget the alternate tax regime? Because as far as the individual is concerned, please remember the rate. I gave you a particular comparative chart. Remember that in the optional scheme, what is the slab rate? In the alternate, in the optional scheme, and in the default scheme of 115 BAC. So in the default scheme of 115 BAC, you know the slab rate up to 3 lakhs, nil, 3 to 6, 5%, 6 to 9, 10, 9 to 12, 15, 12 to 15, 20, and 15 above, 30. Isn't it? Surcharge applicability 50 lakhs to 1 crore. How much is the rate of surcharge? 10%. 1 crore to 2 crores total income, it would be 15%. Above 2 crores, 25%. So in the default scheme, the surcharge maximum for an individual or HUF or AOP BOI is maximum 25%. But in the optional scheme, there is one more slab, that is from 2 crores to 5 crores 25. But from 5 crores above, it is 37. Keep this point in mind. There was one more point which I told you in the default scheme. If you can recall that, one more point, students, that we discussed in the initial lecture was about the rebate part, rebate 87A. Okay, before I go to rebate, one important point to be considered, students, one very important point to be considered is that in the default scheme, students, what exactly we said it in the default, default scheme, the slab rate students will remain the same. That is up to 3 lakhs, nil, 3 to 6, 5, so on and so forth. Irrespective whether the person is a resident or non-resident, we don't care that the person is a resident person or that person is a non-resident person. We don't care on that. So irrespective whether the person is a resident or non-resident, the rate will be the same rate. Same slab. But if you talk about the optional scheme, then for a senior citizen 60 or above, it is up to 3 lakhs, then nil, then 3 to 5, it is 5%, then 5 to 10, it is 20%, and then 10 above, it is 30%. And if you are a super senior citizen, up to 5 lakhs, nothing, 5 lakhs to 10 lakhs, it is 20%, 10 lakhs above, it is 30%. That is one thing that you should keep in mind. Surcharge difference I told you. In the default scheme, what is the surcharge? And in the optional scheme, what is the surcharge? That difference I have told you. Rebate part. In the default scheme, 115 BAC, what is the rebate? At up to 7 lakh students, the maximum rebate. In the default scheme, 115 BAC, up to 7 lakhs, the maximum rebate is how much? No, up to 7 lakh rupees, the maximum rebate is about rupees 25,000. 25,000 is the maximum amount of the rebate for the default scheme. Whereas in the case of the optional scheme, the rebate is when the total income is up to 5 lakhs. Total income is up to rupees 5 lakhs and the maximum rebate is how much? Rupees 12,500. The maximum rebate for this is how much? Rupees 12,500. I hope that all of you are clear with this one. So this is how the things has to be looked upon. Fine, students. So that is the case. How about the foreign company? Foreign company tax rate already we have discussed 40%. Do we have any this scheme, optional scheme and all for foreign company? Answer is no. There is no such this optional scheme and all these things are not there for a foreign company. So far as the surcharge is concerned, there are two rates of surcharge. What is the rate of surcharge? We have discussed this part. Total income more than 1 crore to 10 crore. How much is surcharge? 2%. And more than 10 crores? 5%. So that is for the foreign company. With the rate of tax is 40%. For foreign company students, there is no such default scheme and optional scheme. That is not there for a foreign company. Although for a domestic company, we are going to do it. These rates are important for only reason that while we will be solving now, we will be very near to this thing, practicals and all, competition. So that time, this should be there in your mind. One last point I told you, and I am repeating this point again, that in the default scheme of 115 BAC, students, I told you that, and I am repeating this point again, that because the total income you have to calculate it, total income into rate, there could be some special income. Remember, some special income is subject to special rate of tax. The special income is subject to a special rate of tax, isn't it? And if the special income is subject to a special rate of tax, therefore, first you apply the special rate on that special income, and on the balance total income, apply the slab rate up to 3 lakhs, this 3 lakh to 6 lakh, this, so on and so forth on the balance total income. Okay. As far as the total income is concerned, students, if you see, I told you that in the computation of total income, in every heads of income, some deductions, students, will not be available to you. In every heads of income, students, some deduction will not be available to you. That is what I told. The classic example again, salaries, standard deduction is not available if you go with the default scheme. And you learn further. In house property also, in the SOP property, if the house property is a SOP property, remember there is a 2 lakhs deduction of interest. Those are not available. Chapter 6A, almost all are not available except for 2 or 3 items. Chapter 6A. So therefore, in that case, for the default scheme of 115 BAC, that you all are aware, in this context, the total income, students, the total income will be computed in this particular manner. Many provisions will not be available. In every heads of income, we will not give the deduction, and on that basis, the income of every heads will be computed. Chapter 6A also, there are absolutely 90-95% restriction of taking deduction of chapter 6A, and then thereafter, your total income under the default scheme will be calculated. And once your total income under the default scheme is calculated, thereafter, students, thereafter what? Thereafter, this is going to happen. Once the total income under the default scheme is going to happen, then this is what is going to happen. Is that part clear to all of you, students? Every one of you? Okay, so you calculate the total income under default scheme in this way, and then apply the rate of tax, special income at special rate, balance total income at the balance rate. The balance rate. What is the balance slab rate? Up to 3 lakhs, then 3 to 6, 5, so on and so forth. Okay. In the optional scheme, the total income is calculated normally. There are no block deductions in the total income. So regular provision, whatever is there, regular provision is applicable. And then you apply the rate of tax. In the optional scheme also rate of tax, special income in the total income will be at special rate. Special income in the total income will be at special rate. Balance total income would be at the slab rate if you are an individual or not. And slab rate will depend whether you are a senior citizen, other than a super senior citizen, or a normal person. I hope that this point is well taken to all of you students. Now tomorrow when we meet, tomorrow students will be section number 9. This is done with the residential status completely. Now section 9 will start tomorrow, and that will be a very serious and advanced level discussion that we are in. See you then students tomorrow. Take care.